Hey guys, it's Stan here. Today we're gonna try to answer the question profits versus cash flow, which one is more important? So as always in my videos, we will first define the different terms, so profits and cash flow. What are we talking about when we say cash flow and profits? And also we will stack them against each other to see what are the differences before we talk about the pros and the cons of profits versus cash flow. And at the end of the day, I will give you my personal opinion about that. So let's get started, guys. The best way, in my opinion, to define the terms profits and cash flows is by looking into the P&L, where we get the profits out, and the cash flow, where we're getting, well, the cash flow out. So now let's look in detail what we're talking about. So first of all, in the P&L, that's a very basic P&L, you see. You have the revenues minus the operating costs, leading to an operating profit. And here, and that's what you're usually gonna see, is the term EBITDA, earnings before interest, taxes, depreciation, amortization, which means operating profits. Then we get rid of the loss of value, depreciation and amortization, which brings us to earnings before interest and taxes. That's basically your pre-tax and pre-interest profit. Then we get rid of interest and taxes, which leads to the net profits. I talked about profits 3 times. First of all, here when I said operating profits and I used the word EBITDA, then pre-tax and pre-interest profit, which is the EBIT, and then there is also the net profits. So for you to know, when people talk about profits, they usually talk about operating profits, so the EBITDA here, that's why it's marked in red. On the opposite side, when people talk about cash flows, and I painted a direct cash flow here on the wall, it's pretty simple. Actually, you have 3 compartments. You have stuff that leads to operating cash flow, then you have investing cash flow leading to free cash flow, and then you have financial cash flow leading to our cash end of year. So if you're not very familiar with the financial statements in general, I posted an entire video, half an hour long, explaining the financial statements. I link it here and in the description below. But now let's talk cash flow. So when people say, oh, the cash flows, what are they talking about usually? So first of all, when we start at the top line, we have some cash ins minus our operating cash outs minus interests, which are in the operating cash flow in our cash flow, minus taxes, and all that stuff leads to our operating cash flow. From that, we retrieve our investing cash flow, leading to the free cash flow, which is the cash generation of the company, minus financial cash flow, which leads to cash end of year. So in this case, when people talk about cash flow and cash generation, they're always talking about free cash flow. Why free cash flow? Because it's a very pure measure to measure the cash generation of a company. Think about it. When you talk about free cash flow, you are talking about operating cash flow minus what you have invested, so the investing cash flow, and this leads to your free cash flow. So now that we have talked about the definitions, let's look at the terms. So we are comparing, when we talk about profits versus cash flow, we are talking about operating profits, EBITDA, versus free cash flow, which is the cash generation of the company. So now, why are we doing this? As I just mentioned, in the P&L, there are 3 ways of measuring different kinds of profits. And the reason and why a lot of people consent that EBITDA is the most interesting number to watch is because this has the least, let's call it, noise or pollution, accounting noise or accounting pollution. What do I mean by that? Let's think about it. If we were looking at the net profits, a lot of things have happened until you arrive at the net profits. You have some loss of value here, you have some interest, you have some taxes. So if you are a little bit familiar with accounting, there are a lot of screws where you can play a little bit. You have a little free room to play accounting wise, so that's why there's a lot of noise in the net profits. So this one is not a good term to define the performance of the company. So then people were saying, okay, maybe this number here, earnings pre-tax and pre-interest, but this one as well contains the loss of value, depreciation and amortization, and again you get a lot of accounting noise inside your number, because with the loss of value, let's imagine something depreciates over 10 years. If you depreciate it over 5 or over 15 years, if you are allowed to do that, then obviously the number here changes. So that's why you also have what is called accounting noise or accounting pollution. And that's why a lot of people have agreed, okay, you know what, we're going to talk about operating profits from now on, because that's the least polluted, the most realistic number. So that's why people agreed here, because basically it's only revenues minus operating costs. On the other side, when you look at the cash flow, people have quickly agreed, and investors are always asking about the free cash flow. This is the cash generation of a company. So if you want to know, is my company generating or burning cash, you look at this number here, free cash flow. Now that we know why these numbers here and here have been picked, let's try to find out the difference and which one is maybe better or worse. Now let's compare our EBITDA, so our operating profit, with our free cash flow. As you can see here, my EBITDA is plus 40 because my revenues were 200 minus my operating costs 160 equals to 40 of EBITDA. On the other side, my free cash flow, so my cash generation, is minus 5, so you can see we're pretty far away. And now let's quickly look at the numbers. I have cash ins, so receipts that I have received on my bank account of 170, minus my operating cash outs, which are the same. Then I have interests, which are inside the operating cash flow here, minus 2, minus taxes 8. All this leads to an operating cash flow of 0, minus what I have invested and paid this year, minus 5, which leads to a free cash flow, which is the operating cash flow minus the investing cash flow, and this cash generation is minus 5, which means I have burned 5 of cash this year. So what happened and why do I have such a big difference between both? Well, this is exactly what you are, and this is the question every investor will ask you. And this basically brings us to the topic, why do I have such a big gap between profits and cash flow? And what does it mean? Which one is better? Which one should I look at? So as I just mentioned here, we're talking about the direct cash flow, which means cash ins minus cash outs. What you will see in every investor report that every company is filing, you will always see an indirect cash flow, which exactly answers this famous question, how can I have 40 of EBITDA and only 5 of free cash flow? So here, the indirect cash flow you will see in different reports is always a bridge between a P&L figure, and usually it's the EBITDA, and a cash flow figure. So now let's try out and see what happened. First of all, as you can see, I have a gap between my revenues and my cash ins. So what happened? Why do I have less here? Well, in accounting, it's called accounts receivables, the difference. And in this case, my accounts receivables went up. What does it mean? Actually, I did a great job selling my products. So I have 200, but I have not received all the cash for it because my client did not pay me the entire amount. So here, as you can see, right now we're losing 30, which is the money which is still in my client pocket and needs to be in my pocket at some point. So as you can see here, we have a gap of 30. On the other side, if you look at operating costs and operating cash outs, they're exactly the same. So I have paid all my suppliers, I owe money, so 160, we're good. And by the way, the difference between both, this is called accounts payables in accounting. And when we continue here, you see that my interests of 2, which are below the EBITDA and the profit and loss, are here, as well as my taxes as well. That's just a different convention. between in the because in the cash flow interest and taxes are inside, because we consider that it is vital for a company to pay the IRS or the government taxes, as well as to pay your lenders and the banks your interest. So this is absolutely vital for the company. That's why it's in the operating cash flows. Right now that's a lot of information, I know that, so let's try to bridge it and it's gonna make a lot of sense. So first of all, and that's what I just explained, between the P&L and the cash flow, you have some accounting going on in form of accounts receivables and accounts payables. And if you take the sum of these two concepts, which is basically a delay between when you get revenue and when you get paid, and on the other side, when you have new costs coming up and when you pay these costs, when you pay your suppliers. So this is what this explains. And all this topic is called working capital management, as well as the cash conversion cycle. I made two videos, one about the working capital management, the other one about the cash conversion cycle. I link both in the description below. It's very helpful and very extensive. You will learn a lot of stuff, I can guarantee you. So back to the topic. So as I just mentioned, there is some working capital stuff going on here. So what does it mean for our bridge? Well, let's find out. First of all, as I mentioned, we have an operating profit, so an EBITDA of 40, and we want to bridge it to our free cash flow, so our cash generation of -5. So what happened in between? Well, first of all, as I mentioned before, interests and taxes are included in the cash flow and are below the EBITDA line in the P&L. So you have to get rid of them when you are bridging the P&L to the cash flow. That's what we are doing. We're starting with 40 minus interests minus taxes. And then what is different, again, when we're looking at these two numbers? Well, in the P&L, we have nothing related to investing and investing payments. So here in the P&L, in the cash flow, we have the investment cash flow. We have to get rid of it here, -5, to bridge it. And then what I just mentioned before, as you can see that we're talking about working capital. What happened in our working capital? Did we have some delays between revenues and cash ins and costs and cash outs? Now let's look at it. First of all, easy stuff. Accounts payables, nothing, because we had 160 of costs and 160 of cash outs, so exactly the same. But on the revenue side, my 200 of revenues, so 200 of sales, only turned into 170 of cash ins, which means that 30 are still in my client's pocket, so they're not on my bank account. That's why the working capital here is -30. That's the money I'm still missing right now. And this explains the bridge. So we're going from 40, -2, -8, -5, -30 to a free cash flow of -5. So the first thing you have to keep in mind when you're comparing EBITDA to free cash flow is obviously they come from different financial statements, so they do not mean the same. If you want to know exactly all the stuff about financial statements, make sure to watch my video about financial statements. But what I can tell you to sum up, in the P&L, obviously we're calculating profits, and in the cash flow we're calculating a cash generation or a cash burn, which is not the same logic as I have just explained, because there can be some massive delays between when you are getting revenues and when you are getting paid. That's a big difference. So I think the most important key takeaway from this video you should understand is, first of all, obviously P&L and cash flow are two different pairs of shoes, but the most important thing is EBITDA, in my opinion, is overvalued because it doesn't tell you much about the company. It only tells you, okay, you are generating operating profits, but operating profits are just revenues minus operating costs. That's nothing more. It doesn't tell you if you are generating cash, if your business is sustainable in the long run, and these kind of things. If you wanna have more reliable information about the company and about the company's performance, don't look at the EBITDA, because usually the EBITDA is overstated, and look at the free cash flow, because the free cash flow tells you the real story. There is not much you can hide in the free cash flow. because first of all, the free cash flow takes into consideration the profits, plus it takes into consideration how are you managing your money. Are you able to convert revenues into cash-ins quickly? How are you paying your suppliers? Too fast, too slow? And it also takes into consideration interest and taxes. So if you're looking at free cash flow, if you only have 5 minutes to analyze a company, look at the free cash flow. If it's positive, that's usually a good sign. If it's negative, ask yourself, why is it negative? When I analyze a company, I look first at the free cash flow, because this gives me the real story here. When I look at the free cash flow, for example, -5, I look at the different components. First of all, I see that the operating cash flow is 0, so I'm not generating operating cash flow, so that's kind of a worried sign for me. And then I'm also investing, which turns out into a negative cash generation, which makes sense. Now the question, when I look at an operating cash flow of 0, I want to know where it comes from. And here actually it comes from two things. First of all, it comes from the P&L, and second of all, it comes from working capital. So, two answers here. First of all, when I look at my EBITDA, as you can see, it's positive by 40, which means I'm generating operating profits, which is a good sign. But then I'm not doing a good job with my working capital management, because as you can see, here I'm paying my suppliers as I should, which is okay, 160. But the problem is on the other side. Here, my revenues of 200, I've done a good job selling, but I have not done a good job collecting. And as you can see, the gap of 30 is what drops my operating cash flow to a level which makes my free cash flow negative at the end, which means I'm not generating cash because I have burned money in my working capital here. So here in this case, it's not about generating profits, because I'm generating operating profits, but it's more about managing my working capital correctly. So to answer the question, which is more important, cash flow or P&L, I would put it like this. As I just mentioned, me as an analyst, I would always go for the cash flow first. Check out the cash flow, check out the free cash flow. And then from this point of view, you can say, okay, is my company cash generating or is it cash burning? If the free cash flow is positive, obviously it's a generation. If it's negative, it's a burn. And then the question is, where does this cash generation or this cash burn, where does it come from? And then only I would look at the EBITDA, because where does it come from? Usually it comes from three things. It can only come from three things. First will be the P&L performance. How are my revenues? How are my operating costs? And what is basically my EBITDA margin? So that's first point. Then there is definitely my working capital management. How am I converting my profits into cash? Because as I just mentioned before, it's not a straight line. It's not because you are profitable that you're going to be cash generating. It really depends on your working capital management. And then it's also investment, because in the free cash flow, you are getting rid of the investment cash flow. So if you are investing a lot, let's say you are a new business, you are investing a lot in a new infrastructure, in a new project, for example, then obviously it's gonna drain your cash because you're investing a lot in this new activity. Now I would like to know in the comment section below, how do you analyze a company? What is the most important for you? Are you looking at the profits, or are you looking at the cash flows as I do it in the first place? Now that you know what I believe in, I wanted to tell you that I post once a week every Sunday. So if you're interested in this kind of content, everything related to corporate finance, market finance, make sure to subscribe. Also make sure to like this kind of video. It takes me about 7 hours to do it, to cut it and all that kind of stuff. So make sure to like it. Takes about a second, helps me with the algorithm. I hope you're gonna have a great week. See you soon, guys. Bye bye.